Good morning. Thank you very much for joining us. My name is John West, and I lead client strategies at Research Affiliates. It's my pleasure to host today's webinar, Forecasting Smart Beta, History is Worse Than Useless. At Research Affiliates, we increasingly strive to bring clarity to the growing and broad category of smart beta and factor-oriented investing. As our mission states, we are committed to being the preeminent source of transformative insights that benefit investors. Much of 2016 was dedicated to exploring the impact of rising valuations on smart beta and factor strategies, both over the intermediate term and, shockingly, over the long term, how much those could add or detract to the backtest that we see. And we looked at how smart beta can go horribly wrong by ignoring these valuations and urge prudent investors to look before they leap and ask if the price is right. The main insight we tried to convey was that many factor and smart beta strategies have outperformed solely due to becoming more expensive and therefore creating implausible future expectations for investors when investing in these strategies. We advise that investors should be mindful of the impact of valuations on returns. As a matter of fact, we uncovered that relative valuations of factors or other strategies can predict long-term future returns, not precisely nor with any meaningful market timing ability over the next quarter or the next year, but well enough to add material value to those investors with long time horizons. We found these conclusions to be robust across geographies, different valuation metrics, and over different rolling time periods. Earlier this year, 2017, we released a new research paper. And in addition, we launched a new interactive website to equip investors with a richer toolkit to incorporate all of the research that we've completed over the last 18 months along this subject area. Indeed, backtests don't pay benefits. The Smart Beta interactive site that we're going to walk you through today emphasizes what you're likely to achieve from today. And much of that is driven by valuations and expected transaction costs, not necessarily the last 5 years or even the last 40 years of performance. And so through this tool is our intent for investors to be weaned away from performance chasing and look towards better financial outcomes, particularly setting reasonable expectations. To share the key points of this research and to walk through our new Smart Beta interactive tool, I'm extremely pleased to have Rob Arnott, our founder at Research Affiliates. We hope you find the next hour engaging and informative. And as a reminder, the audience is on listen-only mode with all lines being muted. We'll reserve the majority of today's time together, the next, call it 35 to 40 minutes, for Rob to address your questions at the end of his formal remarks. If you have any questions, please feel free to submit these in the right-hand dialog box. A PDF copy of this presentation and the paper we recently published are available for download. Over to you, Rob.
Thank you very much, John. This is exciting for me because just as we rolled out an asset allocation tool a couple of years ago that can help people sort through the long-term forward-looking returns for asset classes, isn't it nice to have an interactive tool that can help people sort through equity strategies and to gauge which ones are trading rich and which are trading cheap, so that instead of deciding singularly based on past performance, which is a horrible guide to the future, decisions can be made based on relative valuation, which is a much more powerful and much more reliable guide to the future. In many ways, this work is a natural extension and evolution of our research over the last 16 years. We rolled out the fundamental index idea back in 2005, and boy, has it been an interesting decade since then. A horrible decade for value, and yet fundamental index shrugged that off and outperformed the market during a period of time when value was losing, even though we have a stark value tilt in the strategy. Subsequent to fundamental index, Towers-Watson coined the expression smart beta to encompass a whole array of strategies, each of which breaks the link between the price of a stock and its weight in the portfolio, and that winds up being replicable, historically testable, inexpensive, and a host of the classic advantages of indexing. Well, we've done surveys of these strategies, finding, just as an example, that you turn the strategies upside down and they still work. We have done tests on the robustness of factors, and last year we introduced a series of papers examining the whole notion that valuation matters. Well, we all know valuation matters for stock selection. Look at the PE ratio and the yield as part of your decision process. We also know that it matters for asset allocation. Look at yields and comparative spreads relative to history as part of that decision process. Why on earth would we not ask the question, is an equity strategy that we're looking at trading rich or cheap relative to its history? That question typically isn't asked, and it should be just as natural as asking the question, how's it performed? In fact, what we found, and this appeared in our February and again in our June paper, we found that there was a link between starting valuation and subsequent returns. So here on the left you have value as a factor, classic factor, where the value portfolio is the 30% of the market that's trading cheapest, the growth is the 30% that's trading richest, and we look at the comparative valuation. At the time of this analysis, March of last year, it was trading at about 0.13, which means value was 1/8 the price of growth. Well, when we go back historically, we find that when value is trading that cheap, it usually does pretty well. Now here's an interesting observation. Whatever's newly cheap probably got there by dint of inflicting pain and losses. Value had a miserable decade leading to this cheap valuation and leading to an opportunity to buy value rather than getting rid of it. Low volatility at the same time was trading near record highs of relative valuation. Our work suggested that here again, relative valuation has a bearing on subsequent performance and that a negative alpha was likely from the then current valuation levels. We took this work out into a whole array of factors and strategies and a whole array of markets all over the world. We published this work in June. It was based on an analysis through March because March data was the latest available at that time. And what we were looking at was classic profitability as a factor. If you look at the leftmost vertical line on this chart, it goes from 1.5 to 2.5. That means that the high profit margin businesses trade at 1.5 to 2.5 times the valuation of the low margin businesses. That's the historic norm. The little green tick mark there tells us that as of March last year, it was trading right on the historic norm, right in line with historic norms for valuation. So that sounds like it'd be just fine. But if you use price to book value, the second vertical line going from 2 to 4, historic norm was that the high profit margin businesses were trading at anywhere from 2 to 4 times the price to book value of low margin businesses. And the red arrow tells us that we were trading way above the historic median for valuation for that particular factor. So you had a mixed picture. On one measure it's okay, on the other measure it's really, really richly priced, very expensive. The next two lines are for the same strategy, the same factor, measured in international markets developed outside the US. And there, no matter how you measure it, it was trading rich. Quality, high profit margin businesses trading very rich last March. In emerging markets, that's the next two lines, a mixed picture but kind of neutral, meaning that the pricing for quality was in line with historic norms. Then slide over to the next 6 lines, that's momentum. Momentum was trading rich everywhere and particularly rich in international markets. Low beta, the betting against beta factor, was trading extraordinarily rich everywhere, meaning that it was trading at valuation multiples that had not been seen previously. Uh-oh, that's a little dangerous. Illiquidity, another popular factor, Roger Ibbotson's favorite for what it's worth. Pretty neutrally priced in the US, but a little expensive outside the US. Small cap, the size factor, trading a little cheap in the US and expensive elsewhere. Investment, the notion of focusing on companies with low internal investment to avoid companies where empire building is going on. A mixed picture, but kind of negative for the US, pretty good outside the US. And then we come to two value measures, one based on a blend of multiple valuation measures, and one based on the standard price to book value metric. And gosh, this looks awfully cheap everywhere. Now, as we shift our attention from past to present, after we published this in June, what happened? Keep in mind, our work was saying that quality was a little expensive, momentum was pretty darned expensive, low vol was off the charts expensive, and value and size were trading a little cheap. Well, lo and behold, FTSE RAFI, which has a value tilt, beat the market in the next 6 months. Not by a little bit, but by a lot, 4% in just 6 months. Russell Value beat the market by 2.5% in the next 6 months. Low vol, which we identified as being vulnerable, trading at near record valuation multiples, underperformed the market by almost 10 percentage points in just 6 months. Now, if that's not smart beta going horribly wrong, I don't know what horribly wrong is. That was a deeply disappointing outcome, and relative valuation told us that it could happen. Quality underperformed a little bit, consonant with trading a little rich, and momentum underperformed quite a bit, 4% in just 6 months. Outside the US, we found a similar pattern, but boy, in emerging markets value won by 2.5%, and FTSE RAFI emerging markets beat the EM market index by 10.5% in just 6 months. So our work was saying value is cheap, low vol very dangerous all over the world, momentum rather expensive all over the world, quality a little expensive in the US, and pretty expensive outside the US. Well, gosh, I would not have predicted, and I did not predict, that relative valuation would almost perfectly align with subsequent 6-month returns. Our focus is on long-term returns. Now, somebody investing in smart beta might have looked down the column labeled prior 3 years or prior 5 years and might have said, wow, low volatility has been amazing, and gosh, value's been wretched. Let me load up on low volatility and shun value. Well, that would have been the wrong thing to do. This is why we say that past returns are worse than useless. We're in an industry where people are put on a watch list after a couple of years of disappointment and pretty routinely terminated if they have 3 years of disappointment. One of the interesting tests that we've done suggests that if you hire the worst performing mutual funds on a trailing 3-year basis, you'll beat the market by about 2% a year in the next 3 years. Is anyone going to go out and look for that bottom decile of worst performing funds? No, I don't think so. But the point here isn't that that's the right way to do it. The point is that relying on past returns to make our investment decisions is the wrong way to do it. We also went back and published this in September, and we tested a couple of very interesting alternatives. Let's say we could go back to 1977 and identify 8 of the most popular smart beta strategies that are in use today. Now, they didn't all exist in 77, so there's a certain amount of data mining going on there. But if we could go back to 77 and make that decision then, we might equally weight the 8 strategies. That would have added 1.5% a year if you had the blessings of foresight and the blessings of identifying these strategies in advance. Well, that's kind of cool. It's not huge, but it's pretty good. More likely, people would choose the best performing. if you take a blend of 1, 3, 5, and 10-year prior performance and choose the 3 best performing, you would have done 30 basis points worse. If you had chosen the 3 that were trading cheapest relative to their historic norms of valuation, you would have added 50 basis points. You would have also added a little tracking error so your information ratio wouldn't rise, but it's still a good outcome in terms of returns. It's even more dramatic with factors. We took 8 popular factors and we hypothesized that, gosh, back up the clock to 1977 and let's assume we could have identified all 8 factors back then. Pretty naive. But in those strategies, the long portfolio beats the short portfolio by an average of 2.4% a year, compounded for almost 40 years. That's pretty good. If you chose the 3 best performing out of the 8 factors, the 3 that had been most successful on a trailing 1, 3, 5, and 10-year basis, well, gosh, you would have lost half of the efficacy. And if you chose the 3 that were trading the least expensive out of the 8 relative to historic norms of valuation, you would have more than doubled the value add from factors. So we were criticized fairly sharply for suggesting that valuation matters in smart beta and in factors. I think this puts that criticism to task to show why valuation doesn't matter when it so clearly does. The 2 problems we wanted to solve, there's excessive data mining and performance chasing. Strategies and factors won't be introduced unless they have wonderful historical returns. In many cases, these returns are almost entirely a result of data mining, and no effort is made to identify how much of the historical return came from rising valuations. It should be just as automatic to ask whether rising valuations drove our past alpha as it is to examine what the past alpha was in the first place. Investing when relative valuations are at an extreme is classic performance chasing. We know that's wealth destroying in asset allocation. We know it's wealth destroying in stock selection. And we have demonstrated now that it is just as wealth destroying in smart beta. Smart beta can be very smart if used sensibly and patiently. If it's used with performance chasing, the whole advantage of smart beta just disappears. Also, most strategies that are introduced ignore trading costs. Investors operate in the real world. No discussion of returns can be complete without addressing the issues of trading costs and capacity. So, with that as background, let's dive in and take a look at the new website. So, here we are. Welcome to our brand new Smart Beta interactive website. Our toolkit for helping people evaluate whether strategies are trading rich or cheap or about in line with historic norms, and what the implied future alpha is likely to be. Firstly, as I move the arrow down, you can see this is based on the US market. Well, we also have the same data for developed and emerging markets. I'll come back to that. Secondly, you can see here the vertical axis is expected excess returns over the cap-weighted market. And the horizontal axis is tracking error. How much difference are you likely to see in a typical year between your portfolio returns and the market return? And then as we slide over here further to the right, you can see we're doing this net of trading costs. So I'll come back to that in just a minute. Now, looking at this chart, you see a lot of dots. Those dots relate to the strategies that you see over here on the far left. So if I click value, the highlighted strategies are the green ones, just the value strategies. And you can see if you float over to the highest value strategy, what comes up? The RAFI value factor. Think of that as fundamental index on steroids. It takes the deep value stocks and then fundamentally weights them. Okay, well that's an interesting niche strategy. It's certainly not a broad market portfolio. Now, if we look at the full chart again, There's a higher dot here, and it's got lower tracking error too. What's that one? That one, if you click on it, you get a full array of information off to the far left and detail information off on the right side. On the far left, you can see that this is based on our effort to replicate the MSCI quality index. Now, in order to have apples with apples comparisons, we start with the large and mid-cap stock universe and apply the published MSCI quality index methodology on that. So it'll be a little different from their actual index because their index is based on their universe, and we're using a common universe for all of these. As you scan down on the left side, you can see expected excess return over the market, 3.6%. What does that mean? Beating the market by 3.6% per annum for the next 5 years, cumulatively beating the market by 18 percentage points, would be our reasonable expectation. How reasonable? We'll come back to that shortly. Estimated trading costs. Well, you're going to incur some costs implementing this strategy. Our estimate is that if this strategy is run on a $10 billion book of business, the average implementer will find that they execute trades that cost 37 basis points a year, bringing the net benefit down to 3.24% per year. Tracking error is 3.8, gives you a gross information ratio of 0.94, a little bit less for net of trading costs. Volatility, 12.8%, not shown here. That's less than the volatility of the market. And so the Sharpe ratio is pretty good at 0.36. There's further information down below that, but let's go back to the main picture. There's other dots on the graph that are interesting. What about this black one off to the far left? Well, that's the large cap benchmark, and of course, it's got an expected excess return relative to itself of 0 and tracking error relative to itself of 0. No surprise there. You can see some interesting clustering. I mentioned earlier that low vol is trading pretty rich. We have 5 different low vol strategies here. Minimum volatility, low volatility, defensive, 2 RAFI strategies, RAFI low vol and the RAFI low vol factor, a concentrated high octane low vol strategy or factor replication that's fundamentally weighted. Now, the highlighted dots show you that some of these are expected to beat the market by a little bit, this one being RAFI low vol, and some are expected to underperform by a little bit more, minimum volatility. Well, why are most of these below the line? Part of it is valuations. Let me go over here to the upper right, aggregate valuations. I'm going to click this and pop up the full graph. Again, the low vol strategies are highlighted, but you see all the strategies here. What does this bar here for the minimum volatility strategy mean? It means that the minimum volatility strategy has a historical valuation somewhere between 0.8 and 1.1 relative to the market. What does that mean? It means that historically low volatility or minimum volatility has traded at a discount. It's been most typically cheap stocks. The median is that white line in the middle. It's around 0.85 or 0.9. It tells us that historically this is normally traded at a 10 or 15% discount to the market. And look on the upper left of that graph. How are we measuring that? We're doing it with aggregate valuation. We can also do it with the old academic standard of price to book value, and you get different numbers, as you can see here. Scoot back to aggregate valuation. This white dot at the top tells us that, gosh, this strategy is trading at the high end of its range. The range that's shown is from top decile to bottom decile. Anything in the top decile is above this top line. So we're right on the cusp of top decile valuation. For the low volatility strategy, and this uses the S&P methodology, but using the S&P methodology, the valuation is almost exactly 1, Historically, low vol has traded at a discount. Speaking as an investment strategist, I wonder how much downside you're likely to avoid with a low vol strategy if you're paying full market valuations for it. The downside's probably not reduced very much. The defensive strategy is in line with historic norms. The RAFI low vol strategy is trading a little rich, and the RAFI low vol factor is trading, as with the S&P low vol, off the charts, well in the top decile of historical valuations. So here's a strategy that we produced that we would say, you might want to think twice about using it right now. Over on the right, you can see another graph that's kind of interesting. It's estimated trading costs. So I'm now popping that up to see what it shows. What it shows is that if the minimum volatility strategy, which is the MSCI strategy, if that were being run on $10 billion, we would expect to incur about 40 basis points per annum in trading costs. So that's a haircut that you take. The S&P strategy has much more turnover in smaller capitalization names, less liquid names, and has higher turnover outright. So we estimate the trading costs on that to be quite a bit higher. RAFI low vol, very low turnover. It's RAFI on steroids. It's deep value fundamentally weighted. The turnover is very low, and as a result, the trading costs are very low. So trading costs matter. They're hugely important.
So Rob, really the framework you've walked us through is to be mindful of valuations and transaction costs and how that's going to impact future returns. Perhaps on this exhibit you can show the long-term gross of transaction cost returns for these various smart beta strategies, and we can see how those shift. And then maybe you can talk apropos of the title of today's webinar, History is Worse Than Useless, because most people just say, what does the 40-year backtest say about these strategies? And you can tell us maybe a little bit about what your research uncovered of how much information that contains on what they're likely to get for the next 5 years.
Thanks for inviting me to dive into the historical record. You saw the expected excess returns over the market. What if we go back here and choose the historical excess returns over the market? Now let's go over here and switch it to gross of trading costs, because most of these indexes are published without any indication of trading costs. I'm also going to go to the left and click this X so it's no longer singularly focused on the low vol strategies. Well, gosh, what do we find here? The RAFI value factor has the highest historical return, 3.5% above the market per annum compounded. Well, gosh, we introduced that factor a few weeks ago. Was there perhaps a little data mining involved there? Even if inadvertent, I'd have to acknowledge that there probably was. What about the classic value factor? Here we're looking at, Generation 1 value. Generation 1 value is basically the same methodology as the Russell Value Index used back at the beginning, using relative valuation and just throwing out the growth stocks. Its historical excess return is a little less than 1% a year. Well, that strategy does go back to 1979, and this backtest goes back to 1968. So most of that is live in sample results. Now, I'm going to exit this once again and go back to the main graph. Isn't it interesting? Every single strategy works. Goodness gracious. Why aren't there some backtests that have lousy results? Because no one would use those strategies. They're cherry-picked to be the ones that have great historical record. Now you'll notice over on the right there were estimated trading costs. Why don't we look at historical results net of trading costs? Well, gosh, now you've got 4 of them that are underperforming since 1968. if our estimates of trading costs are reasonably accurate. We can also look back and ask the question, how'd these perform relative to the market over the last 5 years? And oh my goodness, there's a cloud there. Looks pretty darn random. When we published the series of papers that began with the paper, How Can Smart Beta Go Horribly Wrong? We weren't saying smart beta is stupid. We weren't saying it's a bad idea. We were saying performance chasing in smart beta may turn out to be a big mistake. And we already saw in the slides earlier that in fact the strategies that were trading rich did in fact perform poorly. Let's pick one of these. Just for the heck of it, let's take that generation 1 value and look at what other information we can find on that particular strategy. Over on the left, you can see expected excess return minus 0.5% per year relative to the benchmark. It's low turnover, so the expected trading costs are only a few basis points, but that's enough to push you to minus 63 basis points expected return. Tracking error is 3.8%, so obviously there's plenty of room for this to turn out to win or to lose a lot bigger than 0.6%. Now, over on the right, once again, we have aggregate valuation measures. Let's click on that and take a look. We can see that value is trading rich if you use generation 1 value, or if you use the concentrated value methodology, or the fundamentally reweighted. Both of those are MSCI methods applied to our limited universe of 1,000 largest market cap companies. Fundamental index is trading a little cheap, and the RAFI value factor is trading right in line with historic norms. Fair enough. Let's look at trading costs. It turns out that concentrated value has the highest trading costs and RAFI, the fundamental index, the lowest trading costs. Why? Because it has the lowest turnover and the lowest difficult turnover down at the bottom of the list. Cool. Other strategies we've already talked about, some have very high trading costs, some don't. There's a third exhibit over on the far right, the model. What is this? This graph shows us the historical relative valuation of value measured relative to growth. And you can see it ranges from 0.55 on the far left to about 0.87 on the far right. That means that the value stocks, Russell 1000 value relative to the Russell 1000, sometimes trades at a 13% discount, sometimes trades at a 45% discount. The vertical axis asks, how well does this perform in the subsequent 5 years? So when it's trading rich, which for value means a discount for sure, because value is defined by the discount, but a skinnier discount than usual. If it's trading at only a 13% discount, historically you normally underperform. Growth wins. Over on the far left, when value is trading at a deep discount, historically it wins by a big margin. And the dashed line is a regression line. It's not a regression line through this scatter plot. It's a regression line through this scatter plot averaged with regression lines in other geographies and other strategies, so that we're borrowing from the information available in other markets and other strategies to get we think, a better handle on the relative valuation.
And Rob, that's a good time. Maybe one of the questions is, how do you come up with these forecasts for returns and transaction costs? So perhaps you can show where that's available. Probably, to be fair, it would take the rest of today's webinar to walk through the entirety of the models, but at least give folks a sense on where they can find this information.
So John, I'm glad you asked that question. We take this regression line, and you'll notice the black dot is current. Russell 1000 value is currently trading a little rich relative to its historic norms. Other value metrics are trading a little cheap, and outside the US, by the way, they're trading very cheap. But if you look at generation one value, simply partitioning the market into growth and value and throwing out the growth stocks, those value stocks are trading a little rich relative to history, about a 22% discount relative to the market. Now, if you look across to the left axis, you can see this is at about a minus 0.5%, that black dot. Well, that's how we compute our expected excess return. Basically, this strategy is trading a little rich relative to history, and its historic norm, that median, corresponds to a slight positive value add over the market. The current discount, which is too skinny, it's trading a little rich, would point to an expected excess return over the market of minus 0.5%. The other information down below is the information we've looked at in the past. I would draw attention to the valuation strategy versus market. Current valuation 77%. That means a 23% discount to the market multiples. The historic median 75%, a 25% discount. And the historical returns 90.91% value add relative to the market going back over the last 40 years. There's other interesting information. If you go up here where it says model, you can also click performance history. Wow, this is an interesting graph. What does it show us? It shows us that the relative performance of generation one value on the green line sometimes is good, sometimes it's horrible. Cumulatively, we know it added 91 basis points a year, but if you held it from peak of the tech bubble here until 2007, you had an incredible return. And if you held it from 2007 until early 2016, you had a pretty miserable ride. This is a year ago is when everybody was trying to fire their value managers. Big mistake. The gray line, notice that the two are joined at the hip. They pogo up and down together. The gray line shows the relative valuation, and it's over on the right scale. So you can see it centers on 0.8. The historic norm is actually 0.75, as we saw earlier. But the two lines are joined at the hip. They go up and down together. What that tells us is that valuation matters tremendously for the efficacy, the future success of a generation one value strategy. We can also see that at the start of 2016, this was trading at a pretty deep discount relative to historic norms, relative to the market, and that's part of the reason it performed so nicely in the subsequent year. We can also go back and ask the question, gee, if we had this model back in time, what would it have predicted? And that forecast historically would have been the gray line and the actual outcome the green line. So this suggests that our methodology is actually pretty good. It does a nice job of forecasting returns. Now I'm going to go back to the main graph. I mentioned that low volatility looked to be kind of vulnerable a year ago and still looks vulnerable today even after about 10 percentage points of underperformance. What if we look outside the US? Gosh, in developed markets, look at the upper right. The aggregate valuation, it's rich no matter which strategy you're looking at. And if you look at the dots, they're kind of anemic, if not worse, pretty much no matter which approach you use, including our own. And if you look at emerging markets, much the same picture.
Good, thanks, Rob. Let's move on to the Q&A section of today's conversation. As a reminder, if you have a question, please submit it in the right-handed or the dialog box on the right-handed portion of your screen. We'll try and get to as many of these as we can. We already have 50, so Rob, get ready to talk like an auctioneer. Let's start with this one. There are two things that stand out as I look at your website. Your own strategies, RAFI, perform best overall and within their categories. And secondly, it is interesting that RAFI Dynamic Multifactor has a lower expected return compared to RAFI Fundamental Index. Can you elaborate on these two observations?
Sure. Firstly, the same research that went into developing the website also informed the design of our products. So it's unsurprising that our strategies would typically look pretty good on the website most of the time. I think the second part of your question highlights the fact that we didn't design this to cherry pick our strategies and make them look best. In fact, here on the home page, there's a strategy that looks even better right now than our own deep value RAFI value factor portfolio. The dynamic multi-factor strategy that we introduced a few weeks ago does not look as good as RAFI right now for a very simple reason. It's multi-factor at a time when value, fundamental index style value, is trading cheap and other factors are not. So if you go with a multi-factor formulation at a time when value is trading cheap, you're probably going to be reducing your returns a bit. Most of the time, I think the dynamic multi-factor will look even stronger than RAFI. But right now, for the moment, it doesn't. It highlights the fact that people hunting for ways to diversify away from value right now may be making a serious mistake.
So the next question is a little bit of a flip of your last observation. What would this model have said about RAFI when it was launched in 2005?
Well, that's a cool question. Let's go back, let's dive into RAFI. Here I'm clicking RAFI to get that index, and you can see it's currently priced to give you about 1.5% alpha. I'm now clicking the model, and I'm now going to performance history, shows its relative performance. That's pretty nice. The wedge between relative valuation, the cheapness of the strategy, and relative performance is pretty pronounced. It has a nice, strong structural alpha. And then when we go back to the model history, let's go back to, we rolled this out in March of 2005. And gosh, our forecasted excess return at the time would have been 1.4%. Not far away from today. Pretty good. Subsequent 5-year alpha was not as good because RAFI got hit hard during the global financial crisis. But roll it forward to just before the quant crash of August 2007, and what do we find? We find that our expected 5-year alpha would be a skinny 25 basis points. So if this tool had been created back then, it would have suggested RAFI, like other value strategies, are trading a little rich right now, and maybe you'll find higher octane strategies elsewhere. Roll the clock forward to the bottom of the financial crisis, and oh my goodness, the expected 5-year return soars to 5.5%. The realized is a lot lower, but that's only because value really still did get savaged for another few years. But value was trading extremely cheap at the time, and so our model would have said this is a great time to embrace RAFI. In fact, it was a great time to embrace RAFI. It just 1.5% value add per year in the next 5 years is still pretty good.
Yeah, particularly when value's not doing well during a good portion of that.
Very good point.
Let's move on to more of a philosophical question. Which smart beta factors, size, value, momentum, quality, etc., do you believe are most durable, and why?
I like to look at these from the vantage point of what I like to refer to as the wedge. Let's go to factors, and let's look at value composite. That's a composite of price to book, price to sales, price to cash flow, and price to dividends, a blend of those four to gauge aggregate valuation. Now let's go to model, and what we can see here is the historic relative valuation and subsequent 5-year return. Now let's look at performance history. When I alluded to the wedge, what I was referring to is you have the green line, the performance of the value factor, and the gray line, the relative valuation of value versus growth, and they're joined at the hip. They go up and down together. But there's a wedge. The green line's headed up, the gray line's headed sideways. That wedge is the structural alpha. So what do we see over on the lower left? We see an estimated structural alpha for the value factor of 2.5% per year. Now, if we turn attention from that to, let's say, momentum. Momentum is a really powerful and interesting factor, and lo and behold, with the same graph, we find a big wedge. We also find momentum crashes galore, going from, had you embraced momentum at the end of the financial crisis, your performance over the next year would have been unbelievably bad. You would have underperformed the anti-momentum strategies by a 2-to-1 margin over the next year. Okay, so what do we find over on the lower left? Structural alpha, it's about the same as value, 2.5%. Cool. It's a nice, powerful strategy. However, and I draw attention to the fact that at the end of this graph, it's now trading cheap. The high momentum stocks are trading at the same valuation, about a 1 there on the scale on the right, same valuation as the anti-momentum stocks. All right, well that's rare. Momentum is usually correlated with price, so it'll typically be picking the higher multiple companies, and you can see the gray line is almost always above 1. When it's below 1, usually momentum performs pretty well. So right now our expected return on momentum is positive. A year ago, it was negative. And so the indications going back a year were avoid momentum, and boy, people who did avoid momentum would have benefited handily from doing so. Today we would say the opposite. Momentum looks good. Keep in mind, these are all gross of trading costs. The size factor, and again, these are factors. These are long-short portfolios. They're not easily replicated. Structural alpha is only 1%. And what was the other one you were asking about?
The other one was low volatility, or I suppose here would be the low beta. Right?
Low beta, structural alpha of less than 1%. What do we mean by that? Well, the gray line and the purple line, the performance chart and the relative valuation, again, as usual, they're joined at the hip. But most of the positive performance of low beta has come from the fact that it's gone from routinely trading at a discount, almost always trading at a discount to the high beta stocks until the financial crisis. Before that, it was always at a discount. Now it's trading at a premium. A year ago, it was trading at a huge premium. A year ago, this work would have said, stay away from low beta. And in fact, they underperformed big in the second half of the year. Today, it would say, still, watch out, but it's less vulnerable than it was. And I guess there was one other that you didn't mention. Gross profitability is a fairly typical measure for quality. Here the revaluation alpha is slightly negative, meaning that the structural alpha is bigger than it seems, but still it's only 1.5%. So the strong ones, people were discussing a year ago about whether value should be discarded as a factor. Well, what a great idea. Discard value as a factor because it's trading cheap. And because it's trading cheap, its performance has been lousy. What a great idea. If you look at structural alpha, you find that value and momentum are the biggies. Cautionary note, momentum is expensive to trade. Turnover is huge. You didn't ask the question, but let me go over to look at momentum strategies. And what you can see in here is the estimated trading costs for the 3 momentum strategies that we've assembled here are 1.5% to 2.5% per annum trading costs, and that's assuming you had $10 billion invested in these strategies. Some of them probably have more than that invested, so they're probably incurring costs even larger than that. I worry about momentum as a standalone strategy. In offering our factor strategies that marry factor tilts with fundamental weighting, I think it's a neat series of products. We will not let people buy them access to the momentum strategy for this simple reason. We think net of trading costs, the alpha will be negative, as it has been for most momentum funds that have been launched over the last quarter century.
So that's a good segue. You partially answered the following question. Some factors like momentum and value offer the highest alpha over the long term. Therefore, how do you justify buying less profitable factors like quality or low volatility? Is that just to simply benefit from timing when these strategies become cheap?
Well, firstly, if you do time the strategies, I don't recommend swinging wildly from one strategy to another. I recommend gently nudging from one strategy to another, gently overweighting the ones that are trading cheap and underweighting the ones that are trading rich. But low volatility and quality do have wonderful attributes, even if the structural alpha is pretty anemic. They're diversifying. Some of these other factors, value notably, takes you in the direction of lower quality companies. Okay, so quality and value wind up being highly complementary. Minimum volatility winds up not having much in the way of structural alpha. But on the other hand, if you're reducing your portfolio risk and don't wind up reducing your returns, it's still beneficial. One nuance that I think is interesting is that people like to think they can get something for nothing, a higher quality portfolio or a lower volatility portfolio with a structural alpha, an ability to have a higher equity risk premium for a lower risk portfolio, or for a higher quality, more comfortable portfolio. Why on earth should we expect a structural alpha from something that reduces risk or improves the quality of the portfolio? At the same valuation levels, sure. If you've got same valuation levels and less risk, that's nice. If you've got the same valuation levels and higher quality, that's nice. But relative valuation matters tremendously.
And so that's a good segue into elaborating a bit on this particular question in terms of how the RAFI dynamic multifactor index allocates across these different factors. And so to summarize, our RAFI dynamic multifactor, which you can find on the plot here, allocates to 5 different factor strategies: value, size, momentum, low volatility, and quality. So maybe you can talk about how with those 5 choices we dynamically allocate and what investors' expectations should be with that particular product over a full holding period.
I think over a full holding period, the RAFI dynamic multifactor will fare pretty well. Let's switch and see what the models suggest about that strategy. Let's go over here to the current indications, which are 1.5% excess return, same as RAFI, but with a higher trading cost. Turnover is higher, so 1.25%. Why lower? Because some of these factors that we're using are trading a little rich. Tracking error, less than that of RAFI, 3.3% a year, meaning a higher information ratio. Volatility, less than that of the market, because you do have a low vol sleeve and a quality sleeve that both reduce risk, leading to a better Sharpe ratio. And the current valuation, a little rich relative to historic norms. So let's go to the compare feature, and I'm going to choose RAFI, and I'm going to choose RAFI dynamic multifactor. Now we've got comparative information in the table down below. Firstly, the dynamic multifactor historically tests to be about twice as powerful as RAFI. Cool. But remember, RAFI was designed back in 2005, dynamic multifactor today. Are we guilty of a little data mining and designing it? Of course, even if we try not to, we're going to do some data mining. So, back to your question, the rather interesting test would be what does it look like in terms of partitioning the historical excess return into structural components and revaluation. And what you can see here is that I'm taking the arrow to point to it. The excess return for RAFI net of trading costs 1.5% going back almost a half century, and dynamic multifactor 2.25%. Tracking error about 10% less for the dynamic multifactor, so the information ratio is drastically higher. Now, the revaluation alpha in both cases is kind of neutral, meaning the structural alpha is pretty much in line with the historical excess returns. Had I run this a year ago, it would have said the revaluation alpha was negative, the structural alpha is greater than the historic norm. This is the whole issue of buy low, sell high, and this is the reason that using historical performance to try to choose strategies is just as bad as using historical performance to choose stocks or to choose asset classes. But you can see here that the structural alpha is better for dynamic multifactor than for plain vanilla RAFI. And it should be. It's a more concentrated portfolio. It's got higher turnover. It's a more concentrated capture of an array of factors. And because of that added concentration, you should expect more.
Well, I think we've got time for a couple of more questions. This one, I'm going to have some fun asking a contrarian like yourself, who generally doesn't like to be with the herd. How crowded is the smart beta space, and if so, how will performance be affected?
Oh, that's a fun question. Firstly, it's very crowded. When Towers Watson coined the expression smart beta, they were referring to mechanistic strategies that break the link between the price of a stock and its weight in the portfolio, that are replicable, historically testable, span the broad market, and in other regards capture some of the benefits of classical indexing. Cool, that sounds pretty smart, especially breaking the link with price. Well, everyone wants to be smart and everybody wants to offer product that's smart, so everybody wants to call their product smart beta. I saw one fund manager introduce a currency hedged share class to one of their international portfolios and say this is our entry into smart beta. That's odd. ETFDB.com published a survey a few weeks ago of the largest ETFs in smart beta. Number one was Russell 1000 Value, number two was Russell 1000 Growth. If you decided, gee, I want to try this smart beta thing, let's look at what the biggest strategies are, and I'm going to put half of my money in each. You just bought the Russell 1000. You just bought the market. Good for you. Is that smart beta? No, that's not smart beta. That's neutral beta. Are those individually smart beta? Well, if one is smart at any given point in time, the other is obviously stupid because one will win and the other will lose. I don't think either of them is smart beta because they link the weight to the price. They're cap weighted. So if you use a narrow definition spanning just strategies that break the link with price, you've got strategies like minimum volatility, low vol, RAFI, fundamental index, equal weight. EDHEC and TOBAM have strategies, risk efficient and maximum diversification, that both qualify for that original definition. Most of the new entrants don't qualify. Most of them I don't think are smart beta. Factor tilts I don't think are smart beta. Your starting point is a cap-weighted portfolio on which you apply a tilt. All right, cap weighting right off the bat is by definition not smart beta. So applying a factor tilt means you're taking bulk beta, broad market neutral beta, and adding a tilt. The tilt might be smart, it might be stupid. The tilt might be smart in the long run and overpriced in the short run. So I don't think factor tilt strategies are smart beta, but I'm losing the definition battle, and the marketplace is basically saying smart beta is almost anything, which means that the label means almost nothing.
Well then, if the labels may mean nothing, how do we make sure that the space doesn't result in nothing, or even worse, in negative excess returns for investors? You started this conversation 15, 18 months ago with a piece called "How Can Smart Beta Go Horribly Wrong?" In a succinct manner, how would you tell investors to not let smart beta go horribly wrong for their own portfolios?
I would say start with redefinition of smart beta to its original definition. Does the strategy break the link with price? If it doesn't, think of it as a strategy, not smart beta. And if you think it's a strategy with merit, great, use it. Secondly, I'd look at relative valuation far more than I would look at past returns. We have a paper coming out shortly that shows that if you use the last 5-year return to choose strategies and funds, your performance is dreadful. So is it just that that's too short a history? No, we went back and used, for smart beta strategies, we went back and used the entire history. And the entire historical alpha is negatively correlated with the subsequent live alpha. You'd actually be better off choosing the strategies with the worst 50-year performance, and you'd do better than choosing the ones with the best. Well, that's a startling observation. That doesn't tell me that historical performance is irrelevant. It tells me that using it as the central basis for deciding on a strategy is a huge mistake. Pairing it with a look at relative valuation makes it much more powerful. If a strategy has outperformed in the past and is trading cheaper now than historic norms, then it's got a big structural alpha. You can use that to your heart's content. So I think partitioning between revaluation alpha and structural alpha is enormously important, and that's actually something that I'm very proud of having introduced to the decision process in our series of papers last year. Again, critics did not like the idea of that partitioning, basically saying revaluation alpha doesn't matter. It does. It matters hugely.
Super. Thanks, Rob. Terrific discussion. Ladies and gentlemen, that is all the time we have for today. There are still a number of questions in the queue. We appreciate your interest. We'll do our best. We'll pass these along to our distribution team and get these unanswered questions out to those of you that asked them. A few housekeeping items. A replay of this webinar will be available this afternoon on researchaffiliates.com. If you're part of our mailing list, all of the research that we've covered, as well as updates to the Smart Beta Interactive tool, we'll be updating this on a quarterly basis, will be sent to you. If you have not registered for our distribution list, please do so on our website. To everyone who joined, thank you very much for spending the last hour with Research Affiliates. And lastly, before you go, we always appreciate your feedback. You dedicated the last hour of your time. Many of you are repeat webinar attendees. We really value your participation. Any way we, in your mind, can make this more impactful to you and to your clients, by all means, let us know. Thank you again for being with us today. All the best.